Since 2008, assets allocated to the managed futures industry have increased by over 50%. CTA assets total more than $325 billion, and of these, 75% are traded by systematic traders, with the majority trend following. With me to discuss managed futures and strategies in more detail is Tim Holmes of Chicago-based Genesis Research and Asset Management. Tim, welcome.
Thank you.
First, let's discuss the futures market. What kind of market are we looking at today?
Well, for managed futures, the last few years have been a difficult trading environment. That said, I think it's still one of the best places for active management, and I believe returns will return. It's also very liquid and transparent, which is good from the investor's standpoint. Over the years, there's been a substantial change in the marketplace, especially in the number of assets being traded. CTA space now is about $325 billion. That can have negative effects on small markets because there's too much capital for the size of the marketplace, which can make systematic strategies difficult. Another very big change in the marketplace has been the replacement of market makers with high-speed trading algorithms. High-speed trading algorithms aren't really market makers. What they do is locate capital pools or liquidity pools and then exploit them. This makes it very hard for systematic strategies to get into and out of the marketplace because they're being discovered and the markets are being moved by the high-speed systems.
So what kind of managers are you looking for at Genesis?
At Genesis, we do use systematic trend followers, but we look for strategies that are small with assets, but also that enter the market in different ways, to sort of disguise their orders from the general marketplace. We also look for strategies that enter the markets or the trends earlier in the cycle. But what we really focus on is smaller market traders, discretionary traders, people that trade in the agricultural markets. We believe that good discretionary traders will always outperform systematic strategies. Their experience and their deep knowledge of the underlying assets or the underlying markets they trade in contributes to that profitability, and we believe that in the smaller markets it's a better way to trade.
And you ask your managers to put at least half their volume into spreads. Why is that?
Spread trading really leverages the experience and the pricing ability of our managers and hones it to be very precise. It's a better way of accessing the complexity of the whole market as opposed to focusing on just what's happening in the front contract. Examples of spreads in the agricultural space would be long July 13, which would be old crop corn, and short D13, which would be new crop corn. These spreads also happen to exist in like Brent crude oil, where you can trade the December 13 versus the December 14 Brent. Spread trading also happens to have lower risk. We believe that it has a lower volatility. And in the long run, we haven't seen that have a detrimental effect on the actual profitability of the strategies. A similar hedge fund approach would be considered relative value trading.
What do you think are the strengths of the relative value strategy against the weaknesses?
The biggest strength of a relative value strategy is it allows the manager to exploit the full breadth of the market. Managers can take advantage of all the nuances and all the different pricings of the different contracts. Crude oil versus the distillates, or beans versus corn versus wheat. All of those things offer trading opportunities for managers. One of the weaknesses of our strategy is that it requires the managers of the fund to be much more precise in their management and to have a lot more experience. You're trading very nuanced products, and it requires the experience of somebody who's actually done it to be able to manage the CTAs in the fund correctly. At Genesis, we believe that our trading experience helps us better understand what our traders are doing and the nuanced moves of the underlying spreads and relationships that are being traded by our traders. Another strength of a relative value strategy is that it tends to have lower drawdowns and less volatility. That said, it doesn't necessarily produce a reduction in returns. So we believe that relative value strategies offer a substantial opportunity with lower risk. Another weakness of a relative value strategy is that it requires more contracts, which increases transaction costs. However, with experienced traders who do every trade with an expected and positive return. We believe that the lower risk and the increased potential for return from relative value strategies more than outweighs the additional cost.
You wrote recently that your philosophy is win by not losing. Describe what you mean.
We learned very early in our career that you have to limit downside. If you can limit your drawdowns, in the long run, the markets will give up return. But you have to be there fully equipped to take advantage of that, and the only way to do that is limit downside risk. Drawdowns and losses affect everybody, even mathematicians. When you have a drawdown in a firm, it detracts from the ability of the people in the firm to continue to think clearly, to act with discipline. It's traumatic, and that trauma affects people. To say that it doesn't is naive. So we focus very much on making sure that the assets of the fund don't experience large drawdowns.
What movements in the market might we expect in the next quarter?
We're actually very excited about the grain markets. We think that the grain markets are going to have substantial opportunities. The supply side is really tight. The demand picture isn't really clear right now, but over the next 15 months, the grain markets are going to be a great place to trade. We also believe that it's an especially good place to trade spreads because of the old crop, new crop phenomena, being able to spread South American against U.S., being able to trade the various products, bean oil against bean meal against soybeans or versus corn or versus wheat. All the different relationships there offer the trader a substantial amount of opportunity going forward.
Tim Holmes, thank you.
Thank you.